Hello, welcome to Any Answers Answered for September 2019. Hopefully you enjoyed your summer and got a chance for a break from the ins and outs of the world of tax and accounting. But we are now very much back into it, and Tim and I have chosen two questions to have a look at on a very similar theme, the same section number in fact, section 455 tax for our more experienced viewers, section 419 tax. And we start with a question from the rather wonderfully named Black Dust 567. Who has a question as follows. I have a client with substantial director's loans at 31st March 2019. The company has voted dividends after the financial year end based on profits generated in that year. The question is, can these be used as repayment of the director's loan at the 31st of March 2019? The director is a shareholder, they clarify, for the purpose of section 455 tax. Now, I think the question that Black Dust is actually asking here is, once upon a time that would have been called a final dividend, and can we sort of pretend it was in the previous year to clear the debt and everything else? Now the answer to that is no. The dividend, if the dividend comes 8 months later, the dividend is 8 months later. But there's nothing stopping him use that money to clear his 455.
That's right. And these days we would look very askance at any suggestion of backdating the paperwork. So let's suppose that this dividend was voted as a final dividend payable on, let's say, the 1st of July 2019. So that fixes the date of payment for a final dividend if it is paid on that 1st of July date, and if in fact rather than being paid in cash it's credited to the director's overdrawn loan account, that's the date that's effective. The accounting issue is not for us to talk about, but clearly that would give rise to accounts showing an overdrawn balance at the 31st of March year end, cleared in the subsequent accounting period. From a tax perspective, it is actually quite straightforward. Yes, there is no difficulty in that credit on the 1st of July clearing the overdrawn balance at the 31st of March 19. And so in the normal course of events, that would mean that there is no section 455 liability, because a fundamental part of section 455 is that to the extent that the loan has been repaid or waived before essentially the corporation tax payday for the accounting period at the end of which the loan is outstanding, there is no 455 liability. So with the 31st of March year end, as long as the loan is cleared by the end of December 19, there won't be a section 455 liability. And clearly those conditions are met in this particular scenario.
Now the question goes on to ask, but what if that loan has increased since that date? So let's say this person is borrowing £10,000 a month. We're saying that there's 120,000 at the end of March. We're clearing that with 120,000 dividend, let's say. But by the time we've done that at the end of December, let's say, then there's another 9 lots of 10,000, so another 90,000 in the loan account. Does that create a problem?
It doesn't, provided we're not in breach of the bed and breakfasting anti-avoidance rules that were brought in a few years ago. One of the correspondents, White Van Man, refers to the bed and breakfast rules and makes it clear that they're aimed at circumstances where the repayment is artificial. And the conditions of the bed and breakfast rule are that there's been a loan repayment of, there's been an outstanding loan, and within 30 days, at least £5,000 of that is repaid, but then at least £5,000 within that 30-day period is taken out again. But only if there's a tax avoidance motive would that apply. And in the not at all unusual situation where a director shareholder is drawing a monthly amount and that's being debited to his director's account, but it is then voted through as a dividend to clear the account, there is a clear legislative get out in as much as if the repayment of the loan that would otherwise trigger the bed and breakfast rule is itself a taxable amount, then it won't trigger the rule. And because that dividend, in your example 120,000, is itself going to be a taxable amount, then the bed and breakfast rule doesn't apply.
So the point is, if I clear that debt using a dividend payment or perhaps a bonus payment, then the bed and breakfast rules simply don't apply. If, however, I had taken money from my savings account to clear the loan just for that 9-month period to prevent there being a 455 charge, and then I take it back and put it back into savings and leave the loan again, that isn't a taxable amount, and therefore the bed and breakfasting rules would apply in that
They
situation.
could indeed, and you could, I suppose, envisage a situation where at the time that the loan is being cleared, you haven't yet formally voted the dividend. Let's suppose we get to December and realise, oops, there's going to be a Section 455 charge on this. And in December, for some reason, someone's on holiday and you can't vote the dividend. So the relevant director makes a repayment out of a savings account. And then in January, the dividend is voted and that could cause difficulty. So we need to be a little bit careful.
The second question relates to the same technical area, Section 455 tax, and the very short-named NH asks a question. Now, the question was actually asked in two parts, and as I read this for the first time, I decided that I had a definite answer after the first part and then completely changed my mind. So let's do the same with Tim. Is there a time limit for claiming Section 455 back? Now, my immediate thought was, if the loan is 40 years old, can I still claim back the money that I paid 40 years ago, if you like, in that situation? To which the answer is yes.
Yes.
Irrelevant how long it is. However, that's not what they meant.
No.
Part two. If, for example, a participator had repaid a loan 3 years ago, but had forgotten to claim the 455 tax, can they now do that? And the answer is?
Yes, they can. 3 years ago. Section 458, and there's a very clear answer to this one. The query arose on accountingWEB because the agent came across a case where the company had simply forgotten to make the claim. So the director's overdrawn account had been cleared, that's fine, and they just forgot to make the claim. These days, of course, you make the claim on the form L2P, which I've always admired as a form because whoever
Loan to
designed
participator.
it, a bit hip that, isn't it? L2P stands for Loan to Participator. And you submit the L2P form and HMRC should then, as long as you're within the rules, make the repayment of the Section 455 tax. However, Section 458 makes it clear that such a claim for repayment of the Section 455 tax has to be made within 4 years from the end of the financial year, that's the year ended 31st of March, in which the loan was repaid. So it's not even accounting period related. You might have a December accounting date, but it's 4 years from the end of the financial year in which the loan was repaid. So if the loan was repaid on, let's say, the 1st of March 2015, that's in the financial year ending 31st of March 15, and we're already beyond that 4-year deadline, even if it was a December accounting date and the loan repayment was in the year to December 15, where we're not yet 4 years from the end of that accounting period. So it's quite important to get those rules correctly applied, but hopefully this will be quite a rare instance because most companies would, I'm sure, remember to reclaim the 455 tax.
But interestingly, the situations where they will probably forget is where they paid over that money to the revenue so many years ago, that 25% at the time now, 32.1%.
Yeah, exactly.
So long ago that they forgot it even was there, apart from it should, of course, be in their balance sheet. But who knows? Well, one topic, but two very important questions, which cover a topic which we do see quite a lot, and we do tend to see people forgetting the ins and outs of Section 455 tax. Therefore, hopefully useful. We look forward to seeing you next month when perhaps we'll be looking at your question on Any Answers Answered. Bye-bye.